Look, I think that is probably the issue for all asset prices in the world, and certainly for the Australian cycle. Namely, you expressed the view that perhaps with gearing now so high, that rates perhaps can't go up. Of course, there was a time back in the 70s and 80s when sometimes rates had to go up. And that, of course, depends on the rate of inflation. So if there were a rise in inflation, then central banks, and that includes the Reserve Bank, would have to raise rates. Because at the moment, for example, even with the very low inflation rates we have negative real interest rates, which probably wouldn't be sustainable if there were inflationary pressures out there. So the greatest risk to all asset prices around the world, and by the way, to Jeremy Grantam's thesis of sustainably higher PEs, would of course be a world in which central banks had to go from being the friend of asset prices to being, as they were for some prior decades, the enemy of asset prices. Namely, they have to slow the economy, they have to slow inflationary pressures. So there are scenarios where that could happen. In the case of Australia, it would be either inflationary pressures or a particularly strong downward pressure on the currency, which might prompt the Reserve Bank to decide that that would lead to imported inflation, and therefore they have to defend the currency to some degree and raise rates. That sort of scenario, of course, would be very difficult for asset prices and also for households who have, as we noted earlier, so much more debt now than they, let's say, did in the last recession in 1991.